Hi, Joe Lopresti here with the latest Arlington Wealth Management Proactive Strategy Update for Friday, September 22nd. Markets continued to correct in the last couple of weeks since our last update. So we're now, say, 7 or 8 weeks into a market correction that began at the beginning of August. In this update, we're going to run through our tactical indicators to see how the correction is progressing, get a handle on if there's still more to come, or if we're getting near the end of this correction. We're also going to cover a couple of items that are a little more concerning on a longer term basis that we want you to be aware of, that we're monitoring. And we're going to give you an update on our market valuation model that is now updated through June 30th of this year. Let's start out by taking a quick look at our proactive asset allocation dashboard. And we could see that, obviously the green arrows are still pointing up in terms of the major market cycle. This correction is not, an end to that cycle, at least not at this point, and we don't believe it's going to end up being that way. The core indicators, we did see a change in the universe trend indicator from positive to neutral. That is expected during market corrections. So at this point, not any major cause for alarm. Cash comparison still remains positive status. The long-term momentum will get an update at the end of next week, and we'll see how that shakes out during this correction. So from a cyclical basis, really no major concerns. In fact, things going along as we would expect during a bull market correction. Moving over to the tactical indicators, we could see that the 10-week chart has moved a little bit more. In fact, both of these indicators moved a little bit more closer to their low risk or oversold levels. They have not hit those levels yet. For example, the 10-week chart was 44% 2 weeks ago when we showed it to you. Now it's 38%. We need to see a reading of about 26 or below to really feel that there's been a good shakeout of market risk according to that indicator. The overbought, oversold indicator, let's take a look at this one. So here you could see the bull market channel that we expect stocks to trade in while our market model is positive, as it has been since November 30th. So this chart starts on November 30th with the buy signal in the model and runs up to current. But we could see another leg down has taken place. There was the first leg really in August, and then a little bit of a recovery, and now we're seeing another leg down in the market. So this has put us, say, halfway between the bull trend average, the middle part of the channel, the blue line, and the oversold area on the chart. Now with this indicator approaching that oversold area, along with the 10-week chart getting closer to its low risk zone, it could be lining up to hit these areas, which could also come in line with the end of the weaker season for stocks. We've talked about August, September. We expected some seasonal weakness. That's what's happened. So as we get towards the end of this seasonal weakness, and it doesn't have to be with a flip of the calendar that stocks suddenly start to strengthen, but sometime as we go into October and towards the end of the year, we get better seasonality that could line up with lower levels on each of these indicators and potentially generate a tactical buying opportunity that could take advantage of opportunities if a year-end rally is going to develop. So according to our market model, what we see is bull cycle still intact, the major market cycle positive. We're getting a traditional correction in that bull cycle. We expect it to set up a potential buying opportunity, particularly if we get a little bit more downside. That correction, the buying opportunity, could be of varying degrees just depending on how far this correction goes before it's over. Now, having said that, there are a couple of items that we're watching that could potentially cause this correction to develop into something more significant to the downside. In our last update, we reviewed our economic models. They've been negative for about a year now. The significance of that is it's a recession warning model, so we expect a recession to develop at some point. If a recession develops, we're likely to see a significant leg down in stock prices rather than just a traditional normal bull market correction. And one of the specific economic statistics that we covered last week was U.S. housing starts. It's a big part of a leading economic model. And we pointed out that there was a big drop last year, which was one of the variables that caused the economic models to turn negative right about this time last year, say in the middle part of the year. But then it stabilized and it was kind of hanging in there. This is where it was when we showed it to you last video update. Well, we now have the latest number out, which just came out this week, and you see a big downturn in housing starts. So if housing starts continue to deteriorate, it could coincide with the start of a recession. And that could mean that if a recession's getting closer, then it could limit any year-end rally in the market and that type of traditional seasonal opportunity that tends to develop in the market. Now, this is just one economic data point. Really, there are many of them that have a vote into the full economic models, but this is something that we wanted to point out that just happened this last week. And another item that we want to point to is one of our indicators. It's not part of the core indicator set that establish buy signals and sell signals that help us identify the market cycle with our market model. However, it is an indicator that we've come over the years to kind of fall back on in a secondary nature because it's been very helpful in certain ways. So what we want to watch is this indicator. We call it our 210-day warning indicator. It calculates the percent of the global stock universe that have a rising 210-day moving average. In other words, the average itself is sloping upward. And what we see in the last few months is there was a big spike up in June and July, and now a big give back of all of those gains in August and September. Now that itself isn't concerning. But what we've noticed in past market cycles is when we get a drop below 50%, that tends to be correlate with an increase in risk levels in the market. So let's go back to 2022. We don't have to go that far back. Bear market in 2022. And we saw this indicator have a big drop, really starting towards the end of 2021, but none of that is concerning. Really, when we get below the 50% level, which happened in January of last year, really all the damage in the market took place from that 50% to the low here in September, October, into the 20% level. So that is important to understand, that when we tend to see a drop below 50%, particularly once it gets up into this higher risk area, as it has recently, and starts to drop, if it gets below 50%, we're going to want to treat this market correction a little bit differently. And it was one of the things that helped us really understand last year that the market correction that was developing at the time looked very similar to this one. Our market model was positive, indicators were coming down, getting into the lower risk level. But once this indicator dropped below 50%, we decided that this wasn't a normal correction. It was potentially the beginning of a more serious bear market. And that helped us to stay more patient with cash holdings, even move more money into cash and protect the downside. Then going to the previous bear market, which was the COVID pandemic decline, we saw this indicator dropping in late 2019 into early 2020. And as that pandemic was developing, this dropped below 50% early February. And that really picked up all of the decline from February into March. That was a very quick 6 or 7 week decline. So again, all of the risk in the market really occurred when this indicator dropped below 50% and then continued down well into the low risk zone at that time. And even going back to the previous cycle, so this was in 2018, we could see the indicator dropping below 50% in August, September timeframe. And from that point to the low in December, there was a close to 20% drop in the S&P and the MSCI All Country World Index. So a drop from above to below 50%, particularly from a higher risk level, is concerning and is one of our warning signals to help us preserve wealth during high-risk market conditions. Now, we don't want to hit the panic button here because we're not there yet. And it's just as likely that this indicator hesitates and stalls out somewhere near this level as the market finishes a correction and starts a year-end rally. Just as likely that that happens as this continue to drop and shift the risk in the market to something that's more significant. So we're monitoring this. We monitor it daily, in fact, and if there are any changes to the status here, we will certainly let you know that our concern is being elevated from this 210-day warning indicator. And the final item that we wanted to cover today is the AWM valuation indicator. This is an indicator that we developed about 2 to 3 years ago because we felt that stocks were highly valued but really didn't have a good way of confirming that they were highly valued. But once we developed this indicator, it confirmed it to us. And the significance of that is when stocks are highly valued, what we found is it's the single biggest variable to predict long-term stock performance. The current valuation of stocks is, in our view, the single biggest variable to predict the long-term opportunity or risk in stocks. So the indicator works like this. When we get a low reading, the blue line here is the indicator itself. Low reading, high reading, low reading, high reading. The shaded areas are what happened from that point over the next 10 years in the S&P 500. So very simply, high at the time, and we're going back to the 1960s here, low next 10-year return in the S&P 500. Low reading, very high 10-year return in the S&P 500. In fact, that lasted for a long time. So if you bought stocks at any time, say from the mid-70s into the mid-80s, even into the early 90s, the next 10 years were high returns. Here's the S&P 500 10-year future performance. So then that brings you to the year 2000, which was, prior to last year, was the highest reading ever for this valuation indicator. And what did that mean in the next 10 years? Stocks struggled and, in fact, turned in a negative 10-year period. So long-term investors should be aware that this is not a good time to buy stocks. This is a better time to buy stocks. This is a better time to buy stocks. Right? In 2009, once that whole excess valuation got worked off and hit its low for that cycle, then the next 10 years were very good returns in the market. So that brings us to present day. And once we developed this indicator, as you can see here, beginning in 2021 and started using it, we were up here, which was the all-time high. So surpassed the year 2000 high. And what that simply means to us is not necessarily from a timing standpoint that you're going to see an immediate decline in the market. In fact, valuation indicators like this are very poor timing tools. But what it does mean is that we expect a low return over the next 10 years. And in fact, this gold area is the prediction by the model, how we expect the S&P 500 to perform over the next 10 years from any point. And you could see for a while there it was negative, and it turned a little bit positive. Well, with the latest data point through June 30th, it's now turned into a negative 10-year return prediction for the market. Now, I'll be the first to tell you, I'm not going to hang my hat on whether the return is negative or positive, in terms of a slightly positive or slightly negative 10-year return. Either one is not a good outcome. If you get a small 10-year return compounded annually is very low return, and adjusted for inflation is probably a negative return. But the point is that we expect low returns for the S&P 500, as opposed to when the indicator is positioned today at a low level, indicating stocks are a good bargain and we could expect high returns for the next 10 years. Now, a couple of side notes on this indicator. Number one is, even during these lengthy revaluation cycles, when we go from high valuation to low valuation, as we did from 2000 to 2009, and as we did from the late 60s to the early 80s, it's interrupted with periodic opportunities where valuations start to improve. And these are bull markets, bull cycles within a longer term bear market. And that's what we've experienced in the last 3 quarters, is a bull cycle within a longer term bear market, we believe. It's only lasted 3 quarters. Sometimes they last much longer. This one lasted almost 5 years, where 2 bear markets, the 2000 to 02 and the 07 to 09 bear markets, were interrupted with a fairly lengthy bull market opportunity. So we have to look out for those types of opportunities developing. The second side note is that this only speaks to the S&P 500. It does not speak to other country markets, which in many ways have much better valuation and could provide good opportunities while the S&P 500 revalues over the long term. It doesn't speak to specific industry groups or other asset classes that could be providing good opportunities and aren't as high priced as the S&P 500. We have to understand that the S&P 500 has become largely a large cap, mega cap growth stock index. It's dominated by the Magnificent Seven as they've come to know today. It doesn't include the thousands of other stocks. At least they have very little weighting in the S&P 500, and of course small companies have no weighting in the S&P 500. So there could be other opportunities developing, but from a traditional S&P 500, which just a lot of investors focus in, and that's where we see a lot of investors' money positioned in those popular stocks, not likely to see strong returns over the next 5 to 7 to 10 years. And in fact, you probably will see very low or even negative returns over that period. So in summary, our market model still shows a positive cycle is intact, and the tactical indicators are beginning to approach their lower risk level that might set up a buying opportunity and a recovery in the market into the end of the year or even the early part of next year. The 2 caveats, and we pointed them out in this update: the economic model continues to be negative, and some recent economic data is beginning to worsen, which could cause a recession to begin sooner rather than later, and that could limit, even prevent, a year-end rally from developing. And our 210-day warning indicator is beginning to approach a level of concern. We're not there yet. We don't want to hit the panic button, because sometimes those indicators get close to signals but start to strengthen and the signal is called off. But we will continue to monitor those conditions and, of course, report on them to you in our next bi-weekly update due 2 weeks from today. And if anything significant were to happen between now and then, we'll be sure to issue a flash alert to notify you. Thanks very much for watching, and enjoy your weekend.